Hello and welcome to Gold and Silver Assets. I'm Diora and it's Sunday the 30th of January 2021. Energy is absolutely essential for civilization. Energy prices are therefore a hugely important financial parameter. What role does energy play in the gold mining industry, and how does the price of oil affect gold mining stocks? As we've discussed previously, there are multiple factors that affect the price of gold mining stocks, and listed here are the main ones. We've got the price of the underlying metal, in this case gold. We've got the oil price, currency exchange rates for the country that the mining is occurring in, as well as inflation. So today we're going to focus on the role of energy costs. Gold mining is an energy-intensive business. Diesel and electricity are directly used to mine and process the gold, but we've also got to remember that there are indirect energy consumption costs as well. So, for example, it takes energy to manufacture the materials and the machinery that the miners use, and even wages are partially going to reflect energy costs through the costs of housing and food for the mine workers. The SRS Rocker report covers a lot of research on how energy impacts the precious metals and mining stocks. Here's one of his charts which shows that in 2018, energy accounted for 14% of Goldcorp's production costs. However, remember that that's just the direct cost. When indirect costs are accounted for, it's been estimated that 50% of production costs of the average gold miner are closely linked to energy prices. The other thing that we should consider is the fact that gold ore grades have been steadily declining over time. And so that would suggest that the energy spent per 1 ounce of gold produced would trend upwards over time. Now, I couldn't find a long-term chart to show that, so I found this one which only covers 6 years, but I mean it kind of suggests a bit of an uptrend, but look, I agree it's not too convincing. I really want to see a long-term chart covering, say, 100 years or something. That would be fabulous, but I couldn't find such a thing. Now, it may be also that the effect of lower ore grades could be offset by increases in mining efficiency. So I really don't know the answer. We really need to get a chart of that. This chart shows the price of oil from 1861 to 2010. The dark green line is the nominal price of oil, and the lighter green line is the inflation adjusted price of oil at $2010. Yeah. So as we can see, it's basically been far from stable before 1900. So kind of before here, we've had lots of ups and downs. And after 1970, again, lots of ups and downs. This time it was reasonably stable, shall we say. So basically we are in the era of unstable oil prices. Let's step back and take a long-term view going back to 1920. So at the top you've got the oil price chart that I showed earlier, and I've aligned this with the Barron's Gold Mining Index shown below. And what I've done, I've drawn these orange lines to show kind of local peaks in the oil price, and you can see that they line up very nicely with local peaks in the Barron's Gold Mining Index. So this suggests to me that steep rises in the price of oil are associated with steep rises in the gold stocks. If we consider that the price of gold is also an important factor for gold mining stocks. We can try and factor that in by looking at the gold to miners ratio. So that's shown here at the bottom. So what it is gold divided by the BGMI index that we saw in the last chart. So a high ratio in this case would tell us that gold is outperforming the miners. And here we can see that certainly since 1970, whenever the oil price has been high, so I'll put 3 spikes here. There's one here, but that seems to be not quite so important there. But in general, since the mid 1970s, let's say, whenever we've had a peak in the oil price, that's always been associated with a peak in the gold to miners ratio. So that tells us when oil prices get very high, then the miners underperform physical gold. We've got 3 occasions where that has occurred so far. Probably actually there's another one over here. It's just, this chart only goes up to 2013 though. This chart shows the gold price in orange, the oil price in black, and the XAU Gold and Silver Miners Index in blue. And this chart starts from the year 2000. So that's basically the start of the gold bull run that occurred then. And I've charted this up to 2009. What I've also done here is plotted it as a percentage so that we can percentage returns so that we can directly compare the 3 assets. Now what we can see is that as the gold price rose in 2008, the price of oil absolutely shot up even more. And although the miners also rose, they underperformed gold towards the end. So if we look over here, it seems to be tracking gold reasonably well. But then around near the end of this move here, you start to see this kind of detachment. And then, of course, during that crash in 2008, all 3 of these assets dropped substantially. In the next gold run from 2009, so what I've done here is zero these returns to the bottom of the golden miners here, which occurred actually in 2008. So what you can see is that we've got a slightly different story here. So oil was actually dropping initially, and the miners actually during that time outperformed gold quite substantially over here, and it continued to do so even as the oil price was rising over here as well. And I think the difference here is that this oil price was more of a slow rise. You didn't get that massive spike that we saw in the last chart. One of the things that's interesting is that the miners actually, you can see here, they peaked before gold peaked. So gold price peaked over here, the miners peaked over here. But looking at it, we can't really attribute that to the oil price. That wasn't really what caused that. I'm not sure about the reason there. Looking at the more recent gold run from 2018, that saw the miners outperform gold, particularly towards the end over here. You can see that here. And interestingly, the oil price dropped very substantially, as we all know. And so in this case, the outperformance of the miners was associated with depressed oil prices. There is, however, something that doesn't quite make sense to me. So, yeah, I'd welcome any comments on this if you know the answer here. I would have thought that if the oil price was high and spiked very high, the miners' margins would drop. But this chart shows that the margins actually continued to increase throughout the whole bull run. And actually, even when oil price was at its peak, the margins were huge here, 50% margins here. Whereas, if we go back to 2001, we're looking at 35% margins. So why, you'd think they'll be raking it in here if they've got such good margins. It may be one potential reason could be that I know that there were a lot of miners that were poorly managed over this time. And I don't know. Interested to hear your thoughts on that. In conclusion, I think in general, spikes in the oil price tend to be associated with spikes in gold mining stocks. But it also seems that physical gold outperforms the gold miners when oil prices are high. The ideal time to be in gold miners is therefore when the gold price is rising and oil prices are dropping or low or minimally rising. Next up, the market update. Let's start with the DXY. So this is on the monthly scale, and that's just so that we can zoom out and have an overview of what's going on here. And so just to recap some of these things. So this red line here was joining this low here and the very bottom of the wick, and the black line is actually joining the body rather than the wick, so it's getting rid of that wick there. And so that kind of gives us this widening zone here, which has proven to be useful because price obviously stalled in that area over here, and we're kind of getting the same thing at the moment. And right now we're right at the very top there. It literally just bounced off that line. And that kind of shows the value of that line, because we drew that months ago. Now, obviously, the dollar is rallying. And so we do need to look at, how high can this go? So what I've done here is join this high here back in, I think it's about 2002 or 3, that kind of time. And I've joined it to this high. Now, obviously here we've got a few wicks here, but of course, that was the unusual activity from last year. Of course, you could draw another line to include that wick. So in the same way that we did down here to include and exclude the wicks. So just keep that in mind, that that's another option there if you think things are going to go above 100, let's say, for the US dollar. But for now, let's draw this because prices on the monthly scale anyway has not closed above that wick so far, and we're looking at almost 2 decades here, and so that's probably going to be an important kind of spot here. So we're looking about between 98, around now 98ish, that kind of level here. Now, yeah, it could go higher than that and come down, but on the monthly time scale we're looking for a close below 98, really. And the real big question is, are we going to get a turnaround at that point, just like we did at both of these points here? Personally, I'm thinking yes. I mean, this is kind of starting to, it's not ideal because of this wick, of course, but you could potentially see a descending triangle here, couldn't you, that's forming. And so, what I'm thinking is we've got this, 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 and then this. And then if we do get a downwards breakout, then we'll go much lower at that point. But of course, that's looking far into the future there. This is the important point we want to look at here. Now, of course, this could be something completely different. And if we get a break outwards, we're looking at pretty high US dollar prices up here relative. Remember, it's relative to other currencies. It doesn't mean that the US dollar is increasing in purchasing power. That's a really important thing to remember. Okay, so yeah, I'm thinking maybe it might pop up a little bit to hit that line, and it could even poke through and come back down again. But yeah, I'm thinking of a turnaround somewhere around here. So let's go back to the silver in New Zealand dollars. And we were talking about this last week, so if you haven't seen that, check that out. But this is just another, just to update you on that. I just found it a little bit easier to look at compared to the US dollar silver chart. And we were talking about this descending triangle, and I was saying I think we're going to get an upwards breakout at some point in the next few weeks. Now, one of the reasons was that, you know, this low here the target would be at or below this low here. Now that's about 20 New Zealand dollars, which at today's prices would equate to about 13 US dollars. That's 1.3, which I don't know. I just don't think that's going to happen. I think that's a low probability event. Of course, I can't say it's not going to happen. There's no certainty in anything here. It just doesn't feel right to me. So, I think last week I mentioned that I was expecting a bounce off of here, a dip, and then breakout a bit later. So at the moment, yeah, we've got a dip, another frustrating drop. I think we've got a little bit more to go. Actually, I think we dropped here. On the daily scale, we bounced up a little bit. I think there's a bit more of a bounce to go. So I'm thinking something like this, maybe one more drop before we start heading up again like this. So that's what I'm thinking. So yeah, we've got another dip coming up, and that would kind of fit with what we're seeing in the US dollar as well. Now remember, of course, if the US dollar goes up, this isn't going to fall as much as the US dollar silver price, if you see what I mean. So this doesn't look like a big drop here, but the drop will probably be bigger in terms of the silver USD price. Okay. So let's look at gold, and again on the weekly scale. And now before I'd drawn this trend line here, which has been holding, and in fact we just bounced off of that over here. But of course, here again we got that wick problem where, although every wick here has kind of hit it on the nail, in fact there's another two here, and then we've got this one here and this one here, just a nudge below that it went, and of course these candles here. But there are two candles here where the wicks went below that line, and so I've drawn a second trend line, just like I did with that US dollar chart, joining the lows with these wicks here. And so now what we've got is a zone here. Like I said, I'm expecting a little bit of a bounce here, and then another dip down, maybe in a couple of weeks' time, I'm thinking. And so in that case, you know, that suggests that this trend line is going to get broken. And so the reason I've drawn this is for another potential line of support here. And of course, the real kind of line in the sand is 1680 here, which joins these lows here. And this is kind of a trading range here that we've been suffering through for the past year or so. Oh God, yeah. I think it's been tough trying to do analysis in sideways movements. It's really tough doing that. Anyway, such is life, and yeah, it's pretty boring, but I think we're getting there. We're not too far off now. So yeah, we still got another 2-3 weeks, maybe even 4 weeks, I don't know. So we'll just have to suffer through that a bit longer. So yeah, so where is this line? We're looking at about 1745, let's say, over there. And then I don't know that it's going to drop much lower than that. Again, we've seemed to have had support over here before at that level as well. And so that kind of coincides with this. So we've got a confluence of support there, I guess you could say. Anyway, yeah, let's see. But what we don't want is for this thing here to break. What we do want is this upper line here to break. And I'm thinking, like I said, up, down, and then boom, boom. And again, the minors. So we had another gap down here. We've got loads of gaps above. So that's a positive, because I think eventually they're going to need to be filled just because there's so many of them. But, and many of you remember I've been talking about this for yonks, is this gap here at around 26.5 here. And that's an unfilled gap. And there's no rule that says all gaps have to be filled, but it always niggles me in the back of my brain. It's always niggling me. And especially when you're getting this kind of price action where it's drifting downwards. And this kind of support level seems to be, I mean, it's been hit 3 times now. And so I think that's going to break, I have to say. And I think this gap's going to be filled, which kind of fits with what I've been talking about in the US dollar and silver and gold. So, and of course, remember that miners react much more than the metals to the downside, as well as to the upside in general. So, yeah, I mean, maybe we'll get a bit of a bounce here, but I just get the feeling it's just a intuition, I guess, that we're going to get that. So just watch out for that. And then finally, we've got the SILJ, and a similar story. We've got that gap here. I think, I mean, that's the only remaining gap below. And as with the GDX, look, we've got a gap up here as well. So, don't despair. Once this gap is filled, then the attentions are going to turn to the gaps above, I think. So yeah, I think we've got a little bit more to sit through, and yeah, it's going to be a little bit of pain and frustration for at least a couple of weeks, I reckon. But I don't know. It's certainly also with the S&P 500. It's interesting. Gold hasn't reacted nearly as badly as the stocks have, and I'm also with the S&P 500. I'm thinking we've just got a little bit of a bounce coming up, one more dip down, and then I think that melt up that we've been talking about is going to proceed, and could potentially be a big melt up. If you remember on the S&P 500, the number that was the low in 2009, I'm thinking a kind of similar kind of number to the upside, if you know what I mean. Some of you will get what I mean here, in terms of where we top. But look, I'm just speculating here. Right, that's it from me for this week. All the best, and see you next week. Hopefully it won't be too boring of a show next week, because again, more sideways movements. Bye.